Hello everybody, welcome to my channel. This is my first video on a series of several investing tips, so if you happen to enjoy, feel free to subscribe, like, share with your friends, whatever you want to do. So today we're going to look at balance sheets and more specifically how to read them. Now, if you're experienced with investing and you already know what a balance sheet is and why it's important, then I suggest that you click off this video. This is not for you. This is directed towards the beginners, the young grads who are just looking to get into investing to make some money on the side or for a possible career, in which case you're better to start researching early. So today I want to talk about why it's important to know how to read a balance sheet. Sorry about that. So let's get started here with an example. Now, let's look at Coca-Cola. It's a very well-known company. And everybody knows what a Coke is. Everyone here has probably had a Coke at one point in their life. Now, balance sheets are basically a combination of assets, liabilities or debt, and shareholders' equity, which we'll get into a bit later. So there's a very simple calculation you need to make before you even look at a balance sheet. You need to know that in a balance sheet, assets is equal to liabilities plus shareholders' equity. So it's a very simple formula, but it's helpful to know. So looking at Coca-Cola, this is the first page of a balance sheet per se. This is taken right off of Yahoo Finance. So if you're interested in learning about other companies, just go to Yahoo Finance. There's all the information you need on that website. So assets are everything that the company owns, whether that be physical objects or intangible assets, which you can see are one of them. So starting off first, we have cash and cash equivalents. Those are pretty self-explanatory. Does the company have a lot of cash? Does it not? Now, once again, it takes a bit of time to realize what is a good amount of cash, what's a bad amount of cash. Really depends on the debt. So one easy way to look at a balance sheet and tell if there are any red flags in the company are to see the debt, short-term debt at least, and then look at cash. And if they don't have enough cash to pay off the debt, that could be something to consider. So you can see Coca-Cola has $6 billion in cash. Normally it's in millions or thousands. Sorry. So next we have short-term investments, which are the company's portfolios, where the money is that they don't have in cash, so where are they putting it. Receivables are the money that they are owed. So if they, it's also known as accounts receivables. And basically if they lent money to a certain company or anything like that, then they will expect to get that money back. It could also be, let's say, if they are expecting returns on a product very soon, then that would go into net receivables. They don't have the money yet, but they will. Next, we have inventory. This one's really also self-explanatory as well. It's just everything they own that's in the warehouses, in the factories, stuff like that. Now, other current assets are just really a combination of anything else, factories, stuff that they own, stuff like that, like where they produce their products. They own the factories, they own the trucks, they own XYZ. So next, long-term investments are similar to short-term investments, but could be investing in a plan or a big group of the company that is looking to seek returns that they haven't yet gotten the returns yet, but it wouldn't be fair to not include that on the balance sheet. Property, plant, and equipment is similar to, it would go into the other current assets file. That's the factories, that's the equipment that they own. So all that goes in there. Now, goodwill is a bit more complicated. That has to do with the company's value to an investor, an everyday person per se. So goodwill is really just the brand name. So everyone's heard of Coca-Cola, and that has a lot of goodwill, meaning that it has value just by being named Coca-Cola. You're much more likely to go to a 7-Eleven and buy a Coke than you are to buy some off-brand soda that claims to be just as good as them. And that's just how the world works. You wanna drink something that you drank before. It makes a big difference. So the goodwill is all of those things that they can't be materialized, but there's value in having a very respected company. Intangible assets are ideas. So if the company knows that if the CEO of Coca-Cola has some great idea and they know it's going to make a ton of money, they can put that onto their balance sheet, and they do, and that's what makes up intangible assets. Now, it's important to keep in mind that the company itself releases the balance sheets, so they determine their goodwill, which it's, you got to decide for yourself whether you think it's the right amount of goodwill or the wrong amount of goodwill. It makes a big difference. Now, so that basically covers most of the assets. There's other assets, deferred long-term asset charges, less significant parts of it, but those are the key terms you want to look at right away. You don't really need to know all of them by heart. You just need to be able to look at goodwill, especially look at cash and cash equivalents, as well as the inventory and intangible assets could be important. Now, they also give you a year-by-year look at it to see how it's changed over time. You can see Coca-Cola, it looks like it's running lower on cash because they're probably investing it in a lot more. As you can see, the short-term investments are going up, cash is going down. So, it's a very fluid chart, and you can use your knowledge to decide what's happening there. So next we have liabilities, and liabilities is just a fancy word for debt. So really it's anything that the company owes that they haven't yet paid off. So first we have accounts payable, and these are investors that have invested that they owe them money. So not invested, more just of a loan. So Coca-Cola owes $2 billion to one company or another. Now, short long-term debt could be it could be anything. It could be a bank loan or a mortgage on property, whatever they purchased really. Now, short-term debt needs to be paid off by the end of the year, and that's just what has to happen. And long-term debt can be delayed for more and more. So a mortgage, for example, would fall onto long-term debt because you're not paying all of that mortgage off in 1 year. You're going to wait, however long before you pay off all the money that you owe. Now, next we have minority interest and negative goodwill. So Coca-Cola doesn't include any negative goodwill because there's really no bad stigma around Coke. A company like tobacco companies might have negative goodwill because they're very well known, and people are very anti-cigarettes now. The population of smokers has gone down drastically. So, that could be a factor in the goodwill. So that would also fall into liabilities. So the final section of a balance sheet is shareholders' equity. And this is, I don't want to say the least important part of a balance sheet, but it definitely, for a beginner at least, you don't need to worry about this as much. It tells a lot less than the debt and assets do, and that's just by nature. So the way you derive it is by taking the assets and subtracting it by the debt. It's not all too complicated in that. So basically the shareholders' equity is just everything that the owners of the company own. So let's say you're going to start a lemonade stand, and you want to buy a lemonade stand for $100, and you invest $50 of your own money, and you take out a loan for $50 of the bank's money. So your debt or liabilities would be $50, but you would also have $50 of shareholders' equity, which is the money that you put into the company itself. So that's basically what shareholders' equity is, and really that sums up the balance sheet. So on the surface, it seems very daunting. There's a lot of big numbers that you might not understand what they all mean, but when you break it down into several sections, it's really not all too complicated. Next week or next episode, depending on when I decide to upload, we'll be going over income statements and general qualitative analysis methods before we get into the more complicated stuff. But thank you for joining me today. If you liked the video, please feel free to subscribe. And yeah, that's it.